Hello, everybody. We're very pleased that so many of you made the time to join us today for our discussion on driving social and environmental change through shareholder engagement. I'm Jamie Broderick, and I'm a director at the Impact Investing Institute. My background is in wealth management and asset management. I'm pleased to welcome to the discussion three people that are very prominent in shareholder engagement in the UK. Sacha Sadan is Director of Investment Stewardship at Legal & General Investment Management. Catherine Howarth is Chief Executive at ShareAction. And Edward Mason is Director of Engagement and Impact Reporting at Generation Investment Management and former Head of Responsible Investment for the Church Commissioners. We're going to start with a discussion with our panelists, then we'll move to your questions, which we're really looking forward to. So please type directly in the Q&A feature, which you should see at the bottom of your Zoom window. And even if you don't have questions of your own, take a look at the Q&A box because you can upvote other people's questions. Before we get to the questions, though, an observation from my past in asset management. In the late 1980s, I worked at an asset management firm in the US, and we hosted a delegation of Chinese government and financial sector people who had come to the US to learn more about asset management. This was 10 years before the asset management sector really got started in China, which was probably in the late 90s. At the time, China had a conservative, socialist economic agenda, but was getting interested in the development potential of capitalism. So we introduced them to asset managers and asset owners around the country. And at the end of the visit, one of the Chinese delegates said, "From what I've observed, the country that has come closest to the socialist ideal of worker ownership of the means of production is the United States." Now, of course, he was referring to the mutual funds and pension funds that he had met that holds such a large percentage of the capital of listed companies in the US. And he viewed the mutual fund shareholders and pension members as the owners. So today, let's explore the power of that ownership and what can happen when owners realize they are owners and start to assert their priorities as owners with their investee companies. So let's start by having each of the panelists give a brief description of themselves and their organizations. Sacha, can we start with you?
Good afternoon, everyone. My name's Sacha Sadan. I'm the Director of Investment Stewardship at Legal & General Investment Management. We're now a £1.3 trillion asset manager. We run a lot of different areas, and we run a lot of money for huge amounts of the UK pension schemes and now globally. And some of our assets are in index funds, which I know we're going to talk about later. But we care passionately about ESG. We have done for years, and I've been there for 9 years now. And so I've been there for a very long time, and I've got a great team, and I'm very happy to share some of our thoughts going forward.
Thank you, Sacha. Catherine?
Good afternoon, everyone. Very pleased to be on this session and having part of this discussion. ShareAction is a registered charity in the UK that holds a small portfolio of shares, which we use very actively to generate impact by opening up a dialogue with large publicly listed companies and their institutional shareholders. We turn up at annual general meetings, we ask questions, we also coordinate investors to come together and write collectively to corporate management. And we feel that that's a very powerful way of driving positive impact. Of course, stewardship, and we'll go into this, is also a way of managing financial risk in portfolios. But it's a hugely powerful tool for creating positive impact in the world by releasing that power of the owner to encourage corporate boards and their management teams to think about their environmental and social footprint.
That's great. Thanks, Catherine. And Edward, you've got two organizations to describe, I think.
Thank you, Jamie, and thanks to the Impact Investing Institute for putting this on. So I'm Edward Mason. I'm the head of engagement and impact reporting at Generation Investment Management. For those who don't know Generation, we're a sustainability focused asset manager headquartered in London, and we invest in both listed and private equity. I sit in the listed equity team. Our vision is to see long-term sustainable investing become best practice in investment, and for sustainable capitalism to become the enduring economic model. And that's what really drives our engagement with the companies we invest in. Previously, as Jamie said, I was head of responsible investment at the Church Commissioners, where I worked for 11 years. And the Church Commissioners manage the Church of England's endowment fund and put a lot of resource into responsible investment. including running a dedicated engagement team. So I've got a fair bit of experience of engagement, largely from the asset owner perspective, and from trying to sort of drive engagement in impactful directions. So very much looking forward to the discussion this afternoon.
That's great. Thanks, Edward. So let me ask, what do we mean by shareholder engagement? What are we trying to achieve? Catherine, you touched on a little bit of this. Do you want to elaborate on that? So just a definition of shareholder engagement.
Sure. Well, I mean, the wonderful thing about being a shareholder is it gives you quite powerful rights. So the first of those is to vote people on and off the board. You have the rights to elect the directors. And that right, in effect, gives you influence over the directors because they want to have your vote every year and vote them in. And so shareholders are in a very strong position to open a dialogue with companies about their long-term strategy, about the risks they're running, about the impacts they have in the world, about how they manage people, about the products they make. And the process of stewardship is one in which investors become more active in the dialogue that they have with companies in their portfolios. And it has levels, so it can become kind of quite activist. So when investors, which does happen, get quite cross with companies, then they start to use those voting rights. And associated with that, there can be a more collective approach by shareholders to put some pressure on directors. But at the softer end, it's very much about a supportive dialogue that ensures that the board of directors are aware of shareholders' interests, concerns, and the topics that really matter to them.
It's a very interesting description, Catherine, because you talk about the softer end and then the advocacy end. And I know, Edward, certainly at Church Commissioners, you have recently been very much at the advocacy end, the visible end. But what else would you add on shareholder engagement? What is it trying to do? What were you trying to do?
No, I would definitely say that that there's a spectrum, and I think often the engagement that stakeholders see is the kind of the most forceful and the public engagement. There's an awful lot that goes on behind the scenes as well. And engagement can take many forms. As Catherine said, it can be with board members, or it can be with functional experts at a company. It could be with investor relations. It can be by an individual investor, or it can be collaborative. It's usually at investors' instigation, but it can also be at the company's instigation. They can reach out about a remuneration scheme or another proposal they have, or just to have regular dialogue with shareholders on environmental, social, and governance issues. But as Catherine said, I mean, sometimes it can be a question of having dialogue and monitoring a company. But at other times, it's very much about pursuing specific objectives, and really can be very firm. And one of the early instances I had of firm engagement was with BP after the Macondo incident, which I'm sure Sacha and Catherine were involved in as well, where we wanted assurance at the Church Commissioners that BP were going to get a grip on safety, because this wasn't the first incident they'd had. And if we didn't get that assurance, we would not have remained invested in the company. And sort of over my time at the Church Commissioners, we really tried to, model a more assertive kind of stewardship on climate change in particular, doing a lot of work in the oil and gas sector, making innovative use of shareholder resolutions that we can come to later on, I'm sure. But I would say that the discipline of engagement has really been professionalizing over the years. And the expectations of stakeholders and regulators have been growing. And there's very much a focus now on outcomes of engagement. And this is very much the direction of the new UK Stewardship Code. So stakeholders and regulators want to see what engagement is delivering. And I think that's positive for the discipline of engagement in this country.
And Sacha, you represent an asset manager. So ShareAction is an advocacy organization, and Edward was at an asset owner, the Church Commissioners, in his previous job. So is the perspective different for an asset manager? And what do you see shareholder engagement differently, or do you see it in the same way that Catherine and Edward have described?
It's similar. I think it depends what aspect we're looking at. So Edward's just mentioned a really good point in the Stewardship Code. Well, we pushed really hard as an asset manager, one for our asset owners as well, but we pushed really hard to have that stewardship code changed. So a lot of this engagement is not about just companies. And I think companies are great because it's a really good story to explain to people that you engage with a company or you pushed for change and you did stuff. But actually changing the stewardship code and having the fact that now we're going to have to be judged more on what we've actually done and the outcomes and impacts, the outcomes and activities statement, I think is a really fantastic point of view. And it's the next evolution of what we've done. Because back to the definition, and Catherine and Edward have done a great job of defining it, but the word engagement has been, I think it's been a bit of a dirty word. It's been, because it was always easy for an asset manager in the past to go, oh yeah, I engaged, I met them. I had a discussion with that company, and it's like, well, what did you do? I mean, you had a nice discussion, and it was a very British thing. We decided, we agreed to disagree, and we walked that way, and they walked that way, and we didn't do anything. And so people got the word engagement, and they probably used it in an unfair way. And I think we need to be able to say, you know, sometimes our engagements are very advocacy, and they're very friendly, and there's other ones where we gang up with many others, and we put pressure on the company, or we put pressure on the industry, the FRC as an example, for change, because that's what's in the interest. So an asset manager is linked to that because we're in that chain, but absolutely there'll be other times where we are specifically on our own, chairman, your CEO needs to leave, and we don't want to wait to the AGM. And that's where maybe a large asset manager can have that voice, because we're very fortunate to have that one-on-one conversation, not just at the AGM. But everyone gets a different voice in engagement, but you must use impact. And it doesn't mean sell an impact fund, it means impact of the engagements. Why are you bothering meeting 300 companies if you've not got a view or a purpose of what you want to get out of it?
I think we're really bringing out some interesting topics. I mean, you've talked about this kind of gentlemanly monitoring of someone, which is how a lot of people think of engagement. I think of engagement as being a very exciting opportunity. And you said the word impact, and I think the opportunity to have impact through engagement, I'd love to see if we could bring that out. But first, Catherine, let me ask you, so we've mentioned climate change. What other topics, and we talked about the title of this discussion is achieving impact through engagement, social and environmental impact. What other forms of social and environmental impact other than climate do you see in your work that you do?
Well, climate is obviously a very systemic one, because every company has a footprint on the climate at some level. Some very high carbon companies have a huge impact on climate change, and others much less. But you know, every company does, including in its products and so on. But the other really systemic issue is the workforce. Every company has a workforce, and investors are increasingly, particularly in the post-corona environment, or the corona crisis, has brought to the fore how critical it is that companies have a responsible approach to managing their workforce, to thinking about the resilience, to supporting people. And actually the smart companies have been seen, you know, are showing themselves to be treating people well, are holding on to people that are talented and strong, people that can help their companies grow. So I think the whole range of issues around the workforce, including everything that's been thrown up by the Black Lives Matter, you know, every company has an opportunity to be more inclusive, to be more fair, to have smart kind of policies that enable talent at all kind of from all backgrounds to thrive and succeed and reach the top of their firm. And those are questions that investors are starting to ask much more. And I think we will see, coming out of the current crisis, a really interesting rebalancing. We will still see climate issues being very prominent, but we will see much more the S of ESG issues being you know, high profile in terms of the stewardship agenda. I've talked about workforce, but I think public health, the impacts that companies have on human health, it's not just the workforce, but that's part of it. But let's just take a topic that's been quite prominent recently, which is obesity. We've seen that people that are, obesity is a real risk factor for coronavirus and for COVID-19. And there are the retailers, the food retailers, who've done hugely well through the crisis, because we've all been, you know, the one thing we've spent money on is groceries, all of us, all over the world. And actually, the retailers are shaping our diets all the time in terms of things like price promotions on sweet foods. And so that's another example of an area where there's real potential for large shareholders to have very, very positive impacts by opening a dialogue on a topic that was maybe not that prominent before. But there are, like in everything in life, there are kind of trends and movements and new issues bubbling up all the time in terms of the stewardship space. It's very exciting. And the potential for positive impact by investors through stewardship, I think, is just becoming more and more clear and apparent in the current context.
Edward, what would you add to that list? Catherine's listed a number of things. What would you add to that? I'm just trying to get people a sense of what the potential is, the kinds of topics to engage in. What would you add to that?
Well, investors engage on issues across the whole spectrum of environmental, social and governance issues. So, in terms of human rights, one of my early engagements at the Church Commissioners was with Vedanta Resources, an Indian mining company who were accused of human rights violations in a tribal area in India. And our engagement there actually involved us going out to see the operations, to talk to NGOs and the tribal communities. And we had a very firm engagement with the company. We talked to Barclays, for example, after the LIBOR scandal, and that engagement focused on culture at the company and whether the company was kind of fixing its cultural issues. We haven't talked so much about governance issues yet. I mean, I would certainly agree with Catherine that diversity matters hugely, and investors have done a lot of work on this, including through the collaborative group, the 30% Club, which has looked for 30% female representation on boards. But on other governance issues, executive remuneration is an important issue, and investors have recently been flexing their muscles quite a bit on that in the UK, for example, on executive pension contributions when these are out of line with what the workforce gets. So there's a very wide range of issues that investors can cover and do cover in engagement and have an impact on. And I think we're going to come to this later on in terms of whether there is evidence that it works, but this has been studied academically, and there is very good evidence that engagement makes a difference, both in terms of achieving sustainability objectives and in terms of improving financial performance at companies targeted.
So let's talk a bit more about that evidence. I mean, what is the evidence? First of all, what does it mean to say that it works? How do you know that it works? And is there academic evidence that says that it works?
Shall I mean, just to carry on that. So, at a very simple level, in the Church Investors Group, we were involved in engagement with companies that weren't disclosing to the Carbon Disclosure Project. And we worked with academics at the University of Edinburgh. And we had a group of companies that we contacted in the engagement program who weren't disclosers to ask them to disclose. And then there was a control group of companies who weren't contacted. And the academics, could see, I think it was with a 95% degree of confidence, that there was a better outcome at the companies engaged than those who weren't. And there are academics, including at sort of Cambridge, London Business School, that have looked at the engagement records of companies that do an awful lot of engagement, some of the engagement overlay service providers, and they've demonstrated the impact, and also that successful engagements have a positive financial impact. There's a really great array of academic research now, and academics have even looked at kind of what are success indicators in engagement. Things like, having a lead engager in collaborative engagements who's from the country where the company is based, and then having international investors who back that, and having kind of substantial investments in the firm in aggregate. Those are the kind of things that make for successful engagements, and that has led into the design of engagement programs like Climate Action 100+, that's having a massive impact in terms of aligning companies with the Paris Agreement.
And James, I mean, so
Yeah,
I will answer it. You think about it. I mean, both of you have mentioned quite rightly lots of things that we've been involved in, all of them. So I'm really pleased about that. So the 30% Club, founding member, who won, who did it, I do not care. You can do whatever you want. But we have many more gender representation on FTSE 100 boards. I think we haven't got a placebo of a FTSE 100 group without it. But to move to 30% from where we were in that short period of time, we still got loads more to do, don't get me wrong, but that was a collaborative effort of full engagement, including us being the first people voting against all mail boards and getting harangued for that, for saying, what's that got to do with finance? So I remember that discussion on the newspaper. You don't get that anymore. So I think I can give you that. I can give you when we've done Japanese board independence with 18 other investors and how the Japanese now have 3 people on the board and now the regulator has done it. But can I just say, just for the record, there's loads of evidence, and Edward said it beautifully. So what? Sometimes climate change hasn't happened yet. I shouldn't wait until there's academic evidence that climate change will destroy value. We're seeing that now, sadly, more and more as we go through. But we were pushing this, and I know ShareAction were, and certainly the church were, 3 or 4 years ago when there wasn't academic evidence. There was enough evidence that it was going to warm up. But we shouldn't wait because our clients expect this. And there's another thing, we shouldn't wait for things to be proven. We should be thinking about things. So the one that I'm going to talk about is tax. The Extractive Industries Tax Initiative, EITI, when we got all the mining companies to put where, and Vedanta being, where are they paying their tax? We did get them to publish that. And now all mining companies publish tax in where they are. That is going to be really important. And I think it's the sort of thing we need to do. But there are many examples, but I don't think we should wait just for evidence, because the fact that people always want to justify financial materiality, no one's going to say that to me on ethnicity, that they're going to have to justify. I think we should be doing it because it's the right thing to do and our investors expect this.
So Sacha, let me pick up on this notion of collaboration, because I think it's an interesting one. You said that you've all worked on some of the same topics. And so then the question becomes, how do you know what you contributed to that whole process if it's always collaborative? So how do you, I mean, when asset managers, and I'll pick on you for this, when asset managers claim that their engagement did such and such and they achieved such and such, when in fact it's actually in all cases pretty much it's going to be a collaborative effort, isn't it?
Well, so I think that there's a few things. The first thing you've got to think about is why are you here? What are you trying to do? And my team and the 9 years I've been here, we are only incentivized on looking after client assets. We do not get paid on selling new products. We don't get, so there's one thing. 2, we don't get paid for marketing, but you're absolutely right. And I know what the question said. There's a lot of greenwashing and a lot of people going, I saved the world. Absolutely. Exactly. But the point is, I don't care who got the credit for auditor rotation, mandatory auditor rotation. How boring a topic was that 7 years ago when we go to Brussels with University Superannuation Scheme, with Columbia Threadneedle and others, because we were saying we want auditors to rotate because we're worried about transparency and the quality of audits, because everyone needs financial trust in the numbers. And look at the scandals we're having and all the stuff we're having. I don't care whether we get the credit or someone else. The fact that there are now mandatory rules and we are now getting changes and we're splitting the role of auditors is what matters. So you're quite right. And that's where we need a ShareAction to try and spread through that and work out who actually did sign that letter. Last week, the one that really cheered me up, that 31 investors wrote to the Brazilian government and absolutely harangued them about deforestation. There's a list of 31 investors. The question you should ask is, where were the other investors? I'm not going to say that. I think Storebrand did most of the work on that and they deserve all the credit. The fact is, the Brazilian government was embarrassed and has already announced it's going to stop forest fires in Brazil for 120 days. That's probably better than the G7 got done. Now, it's only 120 days and we can't give up. But we're not going to take the credit. But what we will do is we'll say we signed that letter and we were the largest asset manager on the planet that signed that letter. And you can work out where it is, but we're not going to say it was because of us, because Storebrand did most of the work. Shouldn't matter.
Okay.
I agree. It's a bit like saying, you know, when you've got a winning football team, which of the players won? Well, you know, it's the team that won. And I think that that's true in collaborative engagements, that it's difficult. It is difficult to pinpoint who. And often, you know, just like in a football team, there'll be a couple of people that played brilliantly or you know, maybe scored the key goals, and they will get you know, there are players in an engagement, a collaborative engagement, that pull more of their weight, but everybody's needed to bring things together. And I would say one of the things that's so wonderful about this whole space is that actually sometimes it's very small investors that can initiate something. ShareAction is a pretty good example of that. But by force of bringing together a broad group, it's very efficient in terms of, bringing people together, but one party kind of does most of the legwork. That's kind of really efficient for everybody else involved. And often the person that leads, or the player that leads, the investor that leads, is particularly passionate about that issue. But they might be a very small investor compared to others that come on board. And so there's this really a real beauty to that, I think, of bringing the big and the small together to bring a message to bear. And I would say, actually, in terms of your question, Jamie, on how do you measure the impact? Sometimes it's easier to measure it on some of the more kind of impact focused things. So we know when we've talked to a company and said, why don't you switch to 100% renewable electric power, and they do it, you've had the impact. On the things where you're trying to manage kind of governance level risk, it is really hard to say whether it was that or something else that meant that the share price then kind of ticked upwards over the next couple of years. It's really hard to disentangle that. Whereas actually the joy of this more kind of impact focused stewardship is that sometimes you can point to some super tangible results and feel really good about them.
But we do have to get used to this notion that this is a team sport. I mean, engagement is a team sport. I love your analogy of the sports team, because you're absolutely right. It's multiple players, and we all have to enjoy the victories together. And you just can't claim it all for yourself. I do have a very interesting question, a very interesting observation, which is it's not necessarily about the AUM, because a lot of people say, what can I do? How could I possibly have an impact? I'm small. I'm just, not something % of the firm. But Edward, I'm thinking about the church commissioners. They're not exactly an 800-pound gorilla in the investment world. I mean, it's a large portfolio, but it's not a big percentage. And yet you've been able to create momentum behind topics. That's just really interesting to me. Can you talk a bit about that? Because I think it's a great question because I hear a lot about, well, we don't have the AUM and therefore we don't have any influence. And people often cite the fact that small investors can't do much. What do you say to that?
I would absolutely say that everyone can do something and everyone can have an impact in this area. Even if as an asset owner, you don't have the capacity to engage yourself, you can have an impact by engaging with your asset manager. And there are some smaller asset owners that have done tremendous work in this area. The Environment Agency Pension Fund, for example, in the UK, has done a great job of pressing the asset management industry to do a better job on sustainability and to get real in stewardship. You've had smaller charities, people like the Joseph Rowntree Charitable Trust that have really, they've pushed asset managers, they've got involved in different engagement initiatives. And, Catherine may be too modest to sort of talk about Barclays and what ShareAction has achieved this year, where, they spotted an issue that really wasn't being worked on sufficiently in the investment industry. And that is bank sort of financing that goes sort of beyond the requirements of the Paris Agreement and therefore risks overshooting the goals of the Paris Agreement. And as a result of that shareholder resolution that was co-filed by many smaller investors, Barclays has committed to a net zero approach to its lending, which is an absolutely tremendous result. And I think what we tried to do at the Church Commissioners and what the Church Commissioners still do is to really use their leverage to maximum effect. And I think every investor can sort of think about what its unique characteristics are. The church has a level of moral authority, it can attract media attention, and it can also sort of champion initiatives within the investment industry that others can then follow. And it's really about, determining what it is you want to achieve, what levers you have, and then pursuing that determinedly. So I think not doing anything should really not be an option for anyone. Everyone can have influence in this.
There's so many, and you've mentioned Catherine's mentioned it, I think it's right. I used to be an asset owner. I used to work at University Superannuation Scheme a long time ago. Oh my God, asset owners, and you've got a great one there from Edward and stuff like that. First of all, challenge the asset manager. Ask them, why didn't you sign that letter on deforestation? Or why didn't, if it's something that you care about? Or Barclays, Catherine did a great job. Did you vote on it? Ask them. You can definitely do that. And secondly, people forget this, and I say this to every asset owner. The fact that you can switch your money, and I'm not saying at all give it to Legal and General or anything like that, but there are good asset managers out there. The power of that, and you've seen with GPIF, the biggest asset owner in the world. Now, they're even the biggest one, and they're still moving money between people because they think of stewardship as really important. But you mentioned Environment and LGPS. It's been an amazing journey that they've put stewardship higher up the agenda. So I think asset owners have a really good, you don't have to be big. And of course, I've said this many times, but some of our best ideas don't come from our internal team. They come from outside. It's like when you run money, James, you get your best ideas where you can. You don't care where they come from. And I think we have to use that. But asset owners have a really good leverage. And I don't think they always know that.
I think you've made two very powerful points. One is, the point, Edward, that you made about each asset owner has a unique profile, a unique perspective, a unique set of attributes they can bring to this. And the church commissioners are a great example of that. And then, Sacha, you've made a really important point, which is you should be making demands, as somebody who owns assets, you should be making demands of your asset managers. And I think it feels to me a little bit like an underutilized tool. So asset owners aren't as demanding as they could be and should be of their asset managers, who are to a large degree managing the engagement process. Would you agree with that?
Catherine first, and then I'll go second.
Well, I was just going to say absolutely. And part of what ShareAction does is try to provide a very rigorous analysis of how different asset managers perform relative to each other on this set of in this area of their work. And there's huge differences out there. So although there isn't an asset manager out there these days that doesn't market itself as just fantastic on ESG and responsible investing, truth is there's huge difference in the marketplace, and it's incredibly important that there's more visibility and there's more competition that we drive into the sector on this. And critically, as everyone has said, that asset owners and clients are flexing their muscles and really doing a lot to scrutinize and interrogate through RFP processes and at the point of awarding mandates, that this is very much more important than it has been historically. By the way, I think the investment consulting community has a hugely important role to play, and I'm very pleased to see how the consulting community is actually stepping up its interest a lot in this area. But I just wanted to come back, Jamie, to the point that you made at the very beginning and opening, which was about the millions of end investors out there, the owners of capital through their retirement savings and mutual funds. And I think that something that we're going to see a lot more of, and the technology is emerging to make this possible, is that pension funds will sort of survey and poll their underlying members to get a sense of their stewardship priorities. What themes are really important? What views do people have about how really high profile votes should be cast at contentious annual general meetings where there's something really important on the ballot? And I know that there's a couple of really large corporate pension schemes, and I won't name them, who are doing some super interesting testing at the moment to use the kind of new technologies available. And what's amazing is that when people get the chance to feed in their views, they become literally multiple times more interested in their pension fund than they were before. So if we're interested in the nation at large and all across the world, people saving more, then actually this whole agenda of issues where people feel more empowered and think that the trustees of their pension scheme, and in turn the asset managers that manage that money, are listening to them about issues they care about when it comes to corporate behavior and corporate performance. That's just such an empowering potential for the investment industry, in a real way that ordinary people who don't have personal wealth to put into impact funds can, through vehicles like pension funds, achieve real impact, real positive impact.
Two quick points on that. You've got to be, you talk about collaboration, asset owners should collaborate.
Yeah.
Because if they just ask their own questions individually, it's great, but they don't get picked off, but they don't get it. But if 20 of them, and we've talked about the defined contribution space, I think that's going to be the one. People's money, it's their money. If they say, we care about climate, these asset owners care about climate, why have you been ranked by ShareAction so lowly on climate? And go for it. And we don't want you to move money, we want you to be ranked high because it would help everyone.
Yeah.
And then the last point, of course, is the consultants. They are so important. So I agree with Catherine.
I think technology is going to help with this as well, actually, in terms of connecting people with their savings. We've got a company that we invest in our sort of private equity sleeve that kind of helps asset managers with platforms, and individual savers can then see kind of their exposure to different areas of impact that they value. I think we're going to see an awful lot more of this, and potentially you could see some democratization of voting as well at AGMs through technology tools where individual savers may be able to have a say over how their shares are voted. So I think sort of financial technology hopefully will help with this process as well.
I want to go to questions because there's a bunch of them, and just a tip to the people asking questions: the shorter the questions, the more likely it is that I can actually understand it. But before we do that, I need to ask my favorite question, which is, how would you contrast divestment versus engagement as strategies to implement change? Are they contradictory? Are they complementary? Anybody here have a view on that? Edward, go ahead.
Look, I mean, my view and our view at the Church Commissioners was always that, this is a kind of false dichotomy that can be created, that it's divestment or engagement. They are both legitimate tools that can be used for different purposes, and they are both powerful in their different ways. So, divestment or restriction of companies or sectors is a really valuable tool if you want to express your values and there are certain areas of investment you don't want exposure to, or if you think that there are financial risks associated with certain companies or areas of investment you don't want exposure to them. It can also be a very powerful political tool, and the divestment movement has been an incredible way of kind of mobilizing people. It has helped kind of contribute to a stigmatization around kind of unethical fossil fuel practice. It affects companies' ability to sort of get talent and so on. So it can be impactful, but engagement is incredibly impactful as well. And all three of us as panelists have seen that. And I would hate to see a financial system in which there weren't active investors, engaged investors out there fighting in the trenches, because there are no easy answers to these huge systemic problems of sustainability. And it needs people prepared to engage over sustained periods of time to effect change. And I think, we've all seen how that process of change works, whether it's how we pressure individual companies, how we build collaborations, how we get, one of the big passive managers that wasn't active on an issue before to exercise a vote in a certain way. I've seen that move things at Exxon, when BlackRock changes its vote on a resolution or on directors, it makes a difference. It directly affects the practice of that company. So my very strong message is both are legitimate, they can be used for different things, and they are both powerful.
And Sacha, what about LGIM? LGIM, which runs a very large passive business, so that must put constraints on you in terms of divestment. What's your perspective on divestment versus engagement?
Well, first of all, we don't run a passive, but we run an index book. And I would challenge anyone to think that we are passive in our engagements with companies. And
Fair enough.
I think Vedanta, Edward would know Vedanta, I think many times they're going, oh God, LGIM back again with the church and other people. They would rather we did divest. So I think there is sometimes that you want to stay in the tent and fight quite hard. But back to Edward's point, you need to use the tools in the toolkit. Now, being large is probably what's the best thing for us. When it's a company and other active investors go, I'm really upset with this, they don't think of Elgin as whether active or index. They don't care. They just go, oh, they're in the top 5. I need their help to get something done. Now, they know that Elgin pick up the phone, whereas perhaps some other investors don't pick up the phone, but that's not because they're either active or index. They can be either, and I think that's quite important. Secondly, boy, they don't like the votes against when you target those votes against directors and when you literally target the votes. And then thirdly, we do escalate it. So the climate impact pledge, which we've done at Elgin for 3 years now, we try to influence companies behind the scenes because we want them to do well. Remember that, we want companies to do well. We are genuinely long-term investors, and you are as an index fund. You can't get more long-term than that. But if they don't do it, you try and engage with them, then you vote against, then you name and shame them, and then you produce products where you ignore them, like Exxon. So you use all your toolkit, and of course, we've seen it with Occidental and Dominion, where we named and shamed them. They've now done the things that we wanted, back to the impact, and they're now back into those products. So you can use that. But of course, we can't win on everything. No one can.
Catherine?
Yeah, well, I very much agree with the views expressed. I think effectively divestment is a part of the engagement spectrum. And in fact, if you engage with a company and they think that, certainly as an active investor, as an active holder, you would never walk away if you didn't get, you know, the change you were seeking through your engagement, then, you know, that's your engagement is already kind of muted relative to having that threat of actually walking away and selling the stock. And as Sacha says, you can always walk back in. So, you know, there are more and more investors who divest and then reinvest when they get what they, you know, when the issues that they were concerned about have been resolved. And, you know, divestment is something that can happen very quietly. You know, you just quietly press sell as an instruction, you know, to a stockbroker, or it can be something that's done in a way that's, you know, highly attention grabbing and engaging to people at large. And so it is a false dichotomy. I totally agree with Edward. It's often been set up as, and I noticed it always gets people going though. So it was very good in the social media to promote this session, engagement versus divestment. And here we are all saying, no, it's not what it's really about. But, you know, it is a little more complicated. But I've spent years saying engagement's really good and divestment can be quite fruitless. And I've come much more to see how powerful divestment can be at the right moment and with the right signals. And I think it's just truly part of a spectrum.
Very interesting. Well, thank you for that. And I bet we could run a whole session on just this topic because it's really fascinating. But I do want to pick up on some of the questions that have been submitted by the audience. One of them is, how do you robustly audit or hold accountable companies who engage in green and social washing? For example, those companies that publicly advocate for ESG policies and practices, but privately lobby against it.
Oh, so I think you mean about, I'll do it from corporate angle and I'll leave it for you. But I mean, part of our engagement on climate, but we'll talk about other things, is we use services that help look at political lobbying. So part of our rankings of companies, and in lots of sectors, not just oil and gas, we look at not what they say to their shareholders in their annual report, because I mean, my slight joke is every single company in their annual report and the thing they say to Sacha when they meet me, you say, we support the Paris Agreement. And I said, well, I support people who do marathons, but I'm not doing one. What are you actually doing? And then I said, well, I've got this report here and it says you spent $14 million saying that, you know, it's not man-made or it's not proven yet. You are going to get ranked badly, you're going to get voted against as chairman, and we're going to escalate it and put you in the Wall Street Journal. So I think you have to look at that, because there is still, I'm afraid, a lot of greenwashing out there from corporates. But there's some amazing companies that are doing a really good job. And the other way, you've seen it with the mining companies, we've pushed them to stop funding the lobby groups that they are affiliated to that aren't linked. And Shell and BP as well are now auditing their own money and looking at that and then saying, actually, that one's not linked with what I've said at the board level. So lots has been moving lately. We've got to get them out there.
Okay. I've got another question. What barriers would the panel envisage to asset managers and asset owners systematically disclosing the outcomes of engagements, irrespective of attribution? In other words, is this always something that's done behind closed doors? Is this always something that's done in quiet conversations? I mean, what would it look like if asset managers and asset owners systematically disclosed their engagements and the outcomes of the engagements? What would
Well,
that?
this is literally exactly where we're going with Sacha mentioned the new stewardship code, and one of the really significant differences between the old code, which was written in 2012, right after the financial well, no, actually first published in 2010, right after the financial crisis and in response to it, and the new code, which was published just a few months ago, is that it requires signatories, so large investors that sign the stewardship code must publicly report on the activities and the outcomes achieved by their stewardship activity, which is now a lot of the industry is scratching their heads thinking, gosh, how are we going to do that? And I think there'll be a lot of very creative work to think about that in a positive way. And it will require some humility and, you know, because it is a team sport, as we were describing earlier. But it's also going to be fantastic, I think, to bring more of the activity that's done into the open. Can I just say one quick word on greenwashing, because it's such a key topic, because as the world becomes more and more interested in ESG issues, companies have more and more of an incentive to paint themselves in a great light on this. And in fact, the worse you are, the more you want to write the most gorgeous, glossy ESG brochure so it is actually a true minefield. And it's one of the reasons why it's super important that the whole area of so-called non-financial reporting, there's a lot of work going on to make that more rigorous and to make that more kind of metrics based and to try and create standardization. So an area we're working on is workforce issues, where with a tool called the Workforce Disclosure Initiative, we're trying to get standardized data, because historically companies have just put a little paragraph about how much they treat, you know, that people are their greatest asset, and then that's full stop, and then there's nothing to back it up at all. So it's a really big problem in the sector, and one where it's very important that big investors are weighing in behind strong solutions.
Isn't it the case that asset managers, active managers, as opposed to, Sacha, what do you call them? Index managers?
Yes.
Active managers often shy away from either being too public about their engagement because they want the quiet conversation, the non-confidential, confrontational conversation. Is that the case?
I find that hilarious. I've loved this job. I find this job, there's so many different things that go on. First of all, we're passive, we don't do anything, and then we now shout too much because we can't leave the room. It's like, you can't have it both ways. An active manager who's a good active, and there's some fantastically good active managers out there, they do push, and when they can, if we can get influence quietly, we will not say a word. We're not loud, shouty people, but when we've had years of not having that, when we collaborate with other investors and we haven't got there, we'll use that. And active managers will also do that in good cases. Our active ownership report, and others do it, we've done 9 years now. I can't believe when some managers say, oh, I can't mention that company I've engaged with. You're like, why not? Maybe wait till you finish the engagement. What was your time frame? Again, we started the conversation about engagements are meant to have a reason for doing it. If you got the thing that you wanted, say something positive. If you didn't get the thing you wanted, say why you didn't get it. So I think we can absolutely report on this. And I know Edward knows that very well.
I think it comes back to the point about everyone using the kind of the tools that they have and the kind of the place that they have in the investment ecosystem. You know, index managers have a great advantage in that they're always going to be around. They can use their tools like sort of voting or speaking out in very effective ways. Active managers may have, quite a large relative position in a company. They will have researched the company really well. They'll know it well. They should have good relationships with the company. So, engagement may be different then, but it can be powerful by leveraging kind of, what's special about that active manager. And that will be, knowing the management team and really being able to leverage that relationship. And the company knowing that the investor is prepared to be serious if the company does not act on issues that really worry the active manager.
I've got another question that asks, is there too much emphasis on engaging on stopping negative things and not enough on promoting positive things in engagement? I mean, do you think of engagement as being more preventing negative than promoting positive?
I think it has to be about both. It needs to be about dialing down the negative impacts and also the more negative risks, and dialing up the positive impacts and, you know, the kind of positive attributes of a company in terms of its commercial model and so on. So I really think it should be a bit of both. I think it is harder to show attribution when you're dealing with kind of risk issues. And it's, as I was saying earlier, it can be easier to kind of show the good news when you've asked a company to do something and it commits to doing it. That's really easy to sort of show the impact you've had as a result of your engagement, which for those of us that are involved, you know, in a major way in engagement, I kind of love those issues where we're looking to dial up the positive and we're looking for the positive impacts, because they lend themselves much better to storytelling. But I do think actually both have a really important role to play in being a good and prudent investor.
I think so if you think of most of our investors, we've got a lot of active and especially a lot of credit funds, but we're not going to go into that debate now. But credit and fixed income are really important because they lend a lot of money and they can influence companies as well. But if you look, we definitely look at minimum standards because we own basically the market and we want to improve the market. So auditor voter diversity, though, I don't understand what on that question. Promoting diversity, is that having less negative or is it positive? I don't really care. It's just I want that, and the reason is academic evidence always says diversity of thought produces better returns. So I don't always look at it as a positive or negative. I think these are things that our clients want. And on climate change, stopping pollution is stopping a negative, but I think I'm worried that those companies will end up being taxed away. So I think it's a bit of both, but I think it's really important that we have minimum standards for everyone.
Yeah, I think that's absolutely right. They're two sides of the same coin. I mean, if you're, engaging with Shell to encourage them to achieve net zero emissions, then yes, they're kind of reducing the negative of their emissions, but then they're going to help, develop a hydrogen economy and a more of a, electricity-based energy system, and they're contributing to transition. And I think there are some great initiatives out there that are about, promoting positives. I mean, one thing that's been going on for a long time, for example, is the Access to Medicine initiative, which is about ensuring that pharmaceutical companies, promote access to their medicines widely, including in developing countries. And I think in the impact space, there's a lot of debate about what being an impact fund in listed equities means. And some funds are now starting to seek to engage with companies to get them to improve their contribution to the SDGs. So I think, again, I would say it can be a bit of a false dichotomy. And again, there's a lot of innovation going on in terms of how investors seek to enhance positive outcomes.
Catherine, you'd mentioned Black Lives Matter, and I've got a question here on the topic. Considering the current racial tensions across the globe, how can shareholders engage corporations in promoting racial justice issues?
Well, I would say it needs to start at home. I think the investment industry is poor on ethnic diversity, and at the same time, I would say that the investment industry shouldn't shy away from challenging companies on this just because it hasn't got its own house fully in order, because we could be waiting forever. And actually, it's the right thing for the investment community to use its muscle to ask companies questions. And Sacha's made the point so well that, the arguments are all out there for diversity pays. We need to attract talent to the top of firms, whatever shape, size, color it comes in, and also we need to treat people right at the bottom of firms. And we have grotesque inequalities within, particularly the US. I think that the inequity between the top and bottom paid is just extraordinary, and that's something that the investment industry has presided over. And go back to your point, Jamie, about acting on behalf of the ordinary mass of people in our economy with pension savings. Well, those people are of every racial background, and they want an investment industry that thinks about challenging companies to treat people fairly, and so I'm very excited about the potential for this issue to kind of really begin to be a bit more prominent on the stewardship agenda.
Well, we've got quite a few things. Very, very briefly. Sir John Parker, who I've worked with quite closely over the years, he's put the Parker Review out 3 years ago, and he put out an interim report in February before the tragedy that's recently occurred. And he's got targets and got stuff, so you can ask how people are linking to that. And we're obviously pushing companies, and we were pushing before, but we've got to have a bit of cynicism here in terms of the industry. Some people have just suddenly signed up to the Race to Work Charter in the last 3 weeks. Well, why weren't they signing it up, asset managers, back to Catherine's point, why wouldn't they signed it up before? I mean, we did it, and we're just a boring passive manager according to people. So you can do this early, but you can ask the managers, why aren't you managing that? Or why haven't you done that? And back to your point of your own house in order, we've announced ethnicity targets in our own firm, and we've now put people on our board. But you couldn't do that unless you've done it ages ago. So you've got to think about these things for quite a while. But absolutely, we can do quite a lot. And of course, at some point, we can influence by voting in these areas as well.
I think one thing that we've been saying in our advocacy as well is that these issues are linked. You know, there are many linkages between these different sustainability challenges. And, you know, we see the moment that we're in at the moment as a moment of opportunity. We've been strong backers at Generation of the Build Back Better campaign, that this is a real moment where we can, you know, reset the global economy, reset how we do capitalism, reset how we do investment, and create a more sustainable economy. So, you know, for us, this is a real kind of, you know, once in a generation opportunity. And I think it's really important that, you know, we should all use this opportunity, whether asset managers, asset owners, NGOs. This is a moment where we can, you know, we can do things better and kind of create real impact.
We have sadly run out of time on a most amazing conversation. So I hope, I mean, I've got questions stacked up. So I hope we can pick up on some of the questions outstanding and maybe revert back to you with some selected responses in our follow-up email. I wonder if the panelists could really quickly, because we're a minute away, some parting advice to smaller investors, how they should be, non-professional, not professional investors, but, you know, probably most of the people in this audience, parting words on what they should be doing in the area of engagement before we go. Can I ask you just a quick bit of sage advice from some very experienced people? What would you tell your average owner, worker, investor about engagement?
Well, I would say don't think that you can't have an influence. So, you know, just pursue it determinedly, find resources that can help you. I think the Institute is going to put some round after this webinar. There's a great one that the PLSA and the Investor Forum have put out on holding asset managers to account on engagement. And also look for peers who can give you advice. ShareAction, for example, run the Charity Responsible Investment Network. There are groups of asset owners like you that you can turn to, find them out and find out what your peers are doing.
Sacha?
Yeah, I mean, very similar. We've got, and we put there, questions to ask your fund manager, things that we wouldn't like to be asked. And so pick 5 topics that you care passionately about and ask them what they've done on it and show, did you vote on those things? And then, of course, the big question to them, where does your ESG team sit in your organization? How much power and credence do you give them? Because they might be doing some great work, but if they're only 3 levels down from the coalface, they can't get that input. And I think the conflicts, we haven't talked about that. I mean, there's rightly your greenwashing cynicism. We do need to make sure that we spot that quite early.
Okay. Catherine, last word.
I mean, the super short answer is come visit the ShareAction website, and there's lots and lots of stuff on there that can help you out. But the longer answer is absolutely what people have said is, if you have funds with any fund manager, just try and send them a couple of questions and check out whether you find their answers convincing. And then, you know, if you want to just go a step further, if you've got shares in a particular company, you know, I can't recommend enough thinking about going to an AGM. This year, because of coronavirus, they're all taking place virtually. So it becomes an easier thing to do than ever. And yeah, turn yourself into a shareholder activist. You know, it's really quite easy once you get going, and very good fun. And you don't have to be, you know, one of the largest fund managers in the whole world like Elgin is. You can be one of the smallest, like we are at ShareAction. And you know, if you've got the conviction and you really care about that issue, often that will just really resonate with the directors. They will hear that and they will respond.
Thank you very much, Catherine and Edward and Sadan, not just for the insights, but for the inspiration, because that's certainly the way I'm feeling right now. I'm feeling really, really inspired by this conversation. So thank you very much for taking part today. And thank you to the audience as well for some fantastic questions for this group. We'd really like to stay in touch with you after this discussion. So we'll be sending you a follow-up email with a link to a recording of the webinar, some of the resources mentioned in the discussion, and maybe we can address some of the questions that didn't quite get the airtime. So please stay tuned for future webinars from the Impact Investing Institute. But meanwhile, goodbye and stay safe.